The purpose of this group is to put people in a room together that would normally never be in a room together.
I used to shy away from property manager. I learned that when you get up to a certain number of units.
Wow, that was a good feeling. So I think that was 2012, 2013.
There are investors who are my clients that haven't even bought it yet.
It's a packed house tonight, man. Everybody just look around real quick. Give a round of applause for the room. And again, special thanks. Stephen, raise your hand. Stephen Leonard Pecker Real Estate. That's one of our sponsors right there. You running a little bit behind. Hands up for Stephen. So, all right, let's get into it. So, and this is almost like a full circle moment. So 2018, 2019, I reached out to Courtney. She had her own meetup on the North Shore, and I was already part of No Real, and I had an idea to kind of start a meetup on the Westbank. Reached out, and she was like, "Yeah, dude, just do it." So she was one of the first guests. We had that first meetup over at Big L's in a big restaurant.
Who was there? Anyone from the crowd that was there?
Elridge was a speaker. You were a speaker. I forgot who the other speaker was. That was like 2018, 2019. But even ever since then, man, just been super supportive. I'm super excited and man, just appreciate the support and how far you've come with the Real, with branching out to other parts also. So we will get straight into tonight. I'm excited for talking about creative financing, which is a hot topic right now because we know right now that the market has got picking up, shaken, and then flipped upside down. So we got to take a couple different approaches. So we're going to go ahead and get started with, first of all, and I brought a notebook tonight, so that's how curious I am how to put these deals together. So I'm excited just like everybody else.
Me too.
Yeah. But first of all, before we get into the meat, how did you even get started, just in case there's somebody in the room that has, you know, a similar position that you were in and scared to take that next step? How did you even get started in the industry?
So I got in the industry in 2014, so 9 years into this. I actually got started. I stumbled. My background is in the nonprofit arena, so I didn't go to college. And I actually had moved back home from living overseas in Thailand, where we were doing some nonprofit work. Moved back home. Actually, I didn't move back home. I came home to visit, and when there was 1 million people in the streets protesting, and it took me a year and a half to get my stuff back. But anyway, when I realized I was staying home for a little while, I had 2 part-time jobs. I realized, hey, I'm going to start kind of getting settled, and a friend of mine said, hey, I'm leaving my full-time job that I think you'll be a good fit for, full-time benefits and a salary. I'm like, I don't even care. I'm sold, right? Because at that point, I'm looking and trying to get stable financially, because a nonprofit world didn't pay a whole lot, right? So I started doing that. The job was, I was a property manager for a marina that was owned by an apartment complex corporation in Slidell. And so some of you have heard me share this story, but what ended up happening was, I told the guy, I said, you know, don't lie to me. What's the downfall? He's like, well, the manager is from New York and he's not nice. And he has cancer. So on Mondays, you're going to be his assistant manager. So on Mondays, when he goes and gets chemo, you're going to need to help him. I'm like, all right, help the mean guy. Got it. I kid you not. That marina was owned by an apartment complex corporation based out of California. I kid you not. The regional manager was in from Mobile to do all my HR paperwork. And on a Monday, while the manager was getting his chemo, and I watched his face go white when he got the phone call that the manager died that day. First day on the job, kid you not. Baptism by fire, trust me, because the guy was like, this is the only marina we own. Like, he was like supposed to train you, and basically told me to figure it out. So day 1 on the job, the marina was 40% occupied and had a 1-star review on all the sites that mattered. And so technically that got me in the real estate industry. But then what happened after that is what really opened my eyes. So just put my head down, and my parents taught me to leave things, you know, better than I found them. So it took me 2 years, and I got the place at 100% occupied. I added some additional slips I was like, I don't know what I'm doing, but like, hey, that area looks like it could, store a boat. Hey, corporate, can you fund, 3 dock boxes over here so we can add 3 more slips? They were like, yes.
What's a slip?
A slip, like a boat slip, like where you store a boat. He asked me earlier to go get the knife out of my vehicle to cut the wire. It's the parking spot that they charge you for the boat
Gotcha.
within the water.
Okay. All right. Okay. All
So
right.
it's a good question. So long story short, value add. I didn't know what I was doing was value add, but like I added 6 additional slips, rental spots while there. I had no idea. I just was bored and curious. But it was during that time I had 2 mentors. One of them was a landlord. The other one was a business owner, and they taught me a ton. But eventually they put the marina for sale. And one of those mentors looked at me and he said, Courtney, you have no idea what you just did for this business. It was a failing asset. Remember, 40% occupied, 1-star review on all the sites that matter, to 100% occupied, additional like revenue sources and slips added, and 5-star reviews on all the boating sites. And he said, you just made them a lot of money, turning this asset around. And he said, if you can ever figure out how to do this for yourself, you'll make more than the $25,000 a year that I was making as that harbor, master. So that was the getting in the industry. But during that time, I bought my first property through understanding those, like he was highlighting those principles of what I was doing. And he said, no, that's a skill set you just did. If you can apply that to, other properties and stuff like that.
And that first deal, that was just something traditional, or you had already started your education?
My education was the landlord tenant who, had a boat there would leave me Rich Dad, Poor Dad, or the Section 8 Bible, Volume 1 and 2. Remember when you had that?
Yeah.
That was who introduced me to it. But so it was getting around other people who were doing it. My first deal was a condo in Slidell. It was a short sale that was on the MLS. So if anyone here is a realtor and you know what a short sale is, or an investor who knows what a short sale is, it's a baptism by fire because into the non-easy deals, because I inherited a little bit of money, $40,000, which may seem like a lot, but it's not that easy to go take $40,000 buy a property. Long story short, I bought a condo for $40,100. And the short sale process was we had to negotiate with the bank for them to accept less than what it was worth. And so that first deal, I bought it. It was like a hoarder situation. So it took me 9 weeks after working all day. Actually, I was working like 60 hours a week at the marina. So it took me 9 weeks after that. And my brother-in-law came over and he was like, here's how you lay flooring. And he showed me how to do like 10%, and I did the rest. And I did 95% of the work on a Home Depot credit card. 1 or 2 years, I think it was 2 years, 0% interest, same as cash if you paid it off in 2 years. Yeah. And it was $5,000 I put on there for like the materials and everything, and then a lot of sweat equity. And then it was worth $85,000 when I was done. And I was like, that's more than I'm making a year. How do I rinse, wash, repeat this? And so while I was at the marina, I got a home equity line of credit.
On that condo?
On that condo. Okay. So I moved into it, got a home equity line of credit, and used that to start buying my next deals.
How'd you learn about that home equity line of credit?
So reading the books.
Okay.
And listening. I started listening to Bigger Pockets and stuff like that. And while I was renovating that, I'd learned about Bigger Pockets. So I was listening to the Bigger Pockets podcast while I was painting, the endless hours in that condo.
Yeah.
So.
And, paint the picture a little bit better. What year we talking?
So 2014,
about? 2014.
Yep.
Okay, cool. First condo, home equity line of credit. What's the next deal look like for you?
It wasn't by a railroad crossing.
Yeah.
So the next deal I bought so that first one, I had a family member who was a realtor who helped me find that one. They said, hey, this might be a good deal, look into it. I didn't really know what a good deal was and wasn't at that point. That takes a while to learn. So the next one, though, I found on Craigslist, and it was a single family house in a trailer in Slidell that I bought for $20,000. Now, That
Both or each?
together.
Oh.
And it was with that HELOC, it was a $60,000 HELOC. So I had $20,000. So I now have $40,000 left to renovate it. And I think that project took me 9 months. And I listened to a lot more podcasts during that time because when I bought it, it had a dinner plate size hole in the wall from termite damage. But I ended up renovating 3 out of the 4 exterior walls and some of the trusses. So I learned my lesson because I bit off more than I chew. I learned another lesson that it was a 1-bedroom, single-family house. Those don't sell quickly. And then the other thing was that cheap deals can run you into the ground because $20,000 sounded cheap, but I ended up only selling it for $58,000. But I think I took a loss of like $4,000 or $5,000 on it. So
you lost money.
I lost money on it, but I learned a heck of a ton.
Yeah.
And I bought it thinking I was going to keep it as a rental, but then when I realized I didn't have any money, because I had quit the marina a week before buying that second property, and I was like, I'm going all in full time. Traded my, sold my SUV, got a truck so I could haul around this stuff. And I was like, I'm going to have rentals. And then halfway through, I said, I'm going to flip this. And then it didn't sell too fast, so.
So tell us a little bit about the mindset at this point. So it seems like that first deal, you had the cash, looked like it went pretty good because you were able to get that line of credit on it. So that probably made you feel good. And then you turn around and lose $4,000. So what's the mindset like before you move forward to the next one? What you thinking?
So the guy, one of the 2 mentors during that time at the marina, the business guy, his name's Charlie. I remember him very clearly. He actually came to that house and we started talking. And I was like, I made the mistake. I bought it like a rental, but this shouldn't be a rental. I'm just going to flip it and I'll just get my money back because I had all my money tied up in this one property and I didn't know, like that was the only money I had access to. I didn't know what I was doing. I didn't know. And he was always a really good voice of reason for me. But I just remember some things that he said, and I walked away and I just said, I just need to lose quickly so I can move on. Mm-hmm. And it wasn't a major amount that would like completely take me out. So I just was like, hey, I just want to move on quickly and learn this lesson quickly so that I can keep going.
Yep. And I wanted to mention that because I want the newer people and the other people to just know that the losses, that's just the nature that we deal with. But I heard a quote today, it's not about the mistakes, but it's about what you do after the mistakes.
Right.
So tell us about that. What happened after that 4,000 loss? What's next?
So the third deal, because I was listening for 9 months to Bigger Pocket podcasts, and I'm a firm believer if you go on the Bigger Pockets podcast, which who here listens to those, right? So especially like the old school podcast, I'm a firm believer if you listen from episode 1 to 300, you can get a master's in real estate really quickly. Would you guys agree? Yeah. Well, I definitely had 300 hours that I was putting into that property. So I was listening through them, and my biggest problem was I had all my capital tied up in one property that I had access to, but I was still like looking for opportunities because I was so engulfed in this new real estate thing. Like, well, what am I going to do if I'm going to find another deal? And another, experienced investor down the line said, well, if you send something, I'll give you a bird dog fee. So I'm like, Google, what is a bird dog fee? And so then it led to some podcasts on wholesaling. And so my third deal was a wholesale deal that I bought in Slidell. I got it under contract in Slidell, and then I wholesaled it, and I made $7,500. And I remember it was Good Friday whenever I closed that deal, because I just remember being like, one, the bank is not open. But the second part was like, it's a good day. It's a Good Friday, because it was more than that. It was proof of concept that I could go out and learn more about like a way to like improve what I was doing. I could act on it and it could produce results. And so I just remember very distinctly that feeling that day of saying, okay, Courtney, if you can just understand this better, you can start doing things. And then that really helped me. And it was like a 30, 45 day win. It was like one of those things where I went driving for dollars. I sent some postcards, and it was like, the woman called me, and we did a deal. I didn't have to like follow up. It was a lay down deal. That does not happen often. And so, but it was one of those things where it was a short period of, I took action. I went and I did some marketing, and that deal happened, and it opened my eyes to, again, the power of, if you go learn and take action on it, things can improve.
Good. So tell us about what kept you from just going over and over and just going deeper into wholesaling. What was kind of the segue to learning this treasure chest of different exit strategies to where you are right now?
So I often say, I cut my teeth flipping and wholesaling. That's what I really started doing in the beginning. Honestly, up until like 2019, that was predominantly what I was doing. 90% of my deals, that was my focus. Because at the end of the day, I'd quit the marina. So I needed my W-2 income that was gone. I needed to put food on the table, right? And so there was a level that I had gone deep into it. You knew me back in those days when I was doing a lot of those deals. Again, 90% of my deal flow was that stuff. But at the same time, I hit this wall where, number one, there's the stress of it because you're only as good as your next deal, right? You have to continuously kill to eat type of thing. But I was like, this is not giving me the like wealth building that like basically brought me into real estate. And so I was like, okay, this is just a rat race, but in a different industry. So that's when I really started to do some like soul searching of like, look, I can keep doing this, but it's not going to be, I read recently, someone said, what good is a house that I sold 5 years ago doing for me today? And I was starting to feel that, right? So what converted me into starting to, add more skill sets, going back to the drawing board to go learn. There's this one deal that's in Covington that I wholesaled. And I only wholesaled it because I did not have access to capital. I didn't know how to get the access to capital. And yeah, I made like 20 grand on it. But and some people like, oh, 20 grand, but like, you don't understand that quick cash is addicting, and it's really hard to break that cycle from flips and wholesales. But at the end of the day, again, it's not building your tomorrow. I call that today money, right? That money has I don't feel any of that money right now, right? But that was what I consider what is a legacy property for me right now, should be in my portfolio, and it's not. So if I ever need a good stir things up, I have like 3rd-degree burns underneath my from that property, because I consistently go back like a masochist and be like, because I had it under contract at $92,000, I sold it. I think I sold it for $115 or something like that. So made some quick cash. It needed less than $30,000 in work, and it's worth $285 today. And so, it was built in 2008, 3-bedroom, 2-bath, 2-car garage. Should be a rental all day long in my portfolio. That's a legacy property. So for those of you who enjoy selling, if you don't regret selling one, you just haven't sold enough. And so that is what, it was purely because I did not have the skill sets to acquire that one deal, and I just got pissed. I was just mad. I was like, it's because I don't know how to get access to the capital or whatever. So that is what sent me to go learning. And so I learned how to do 2 things: to raise private money from everyday individuals, and then also creative financing to be able to utilize either the selling or the existing mortgage in place. That property all day long, from what I know today, I could have bought that property on terms all day long.
Yeah, and what does raising money in day-to-day real world look like? So the books and the seminars, 1, 2, 3 show you how to raise money. But in reality, what is the slow grind? If I want to raise capital, what does that look like for me tomorrow morning?
It literally looks like coffee and lunch with people. It's called relationship money for a reason. And it's in the same way that I get the discounts I need on the properties, the investment properties that we buy, the same way that we need a discount to make the numbers make sense. We get that by solving sellers' problems. In the same way that we can justify that discount that way, it's the same way that I can build relationships with people who want to lend private money to me. It's because they have a problem with that money. And so, but no one's walking around with a sign on their head saying, I'm in pre-foreclosure, right? But they're also not walking around with a sign on their head that says, I have money sitting in the bank making less than 1% interest. So you only find that out by learning how to build relationships and ask good questions. But even more than that, I think that that's a very bland answer for the build relationships. You have to build allies, people who want to, like, a relationship where there wants to be mutual benefit, and to the degree that people like, know, and trust you. There was a level that I was such an island doing things that people didn't. If you followed me on social media, I didn't talk about any of the deals I was doing until like 2020. Like, because I started realizing I was being such a secret agent in what I was doing, or a secret professional in what I was doing. And I'm like, no one, first of all, was knowing what I was doing, or like if you were asking, your neighbor, would they know what you do? They're like, I don't know, she's a realtor or something. I'm like, not exactly. I'm not licensed or anything like that, but kind of with houses, right? Yeah. So it's really finding those allies. And then next thing you know, you're like, I've gotten private money from sellers when I was, wholesaling deals.
Yeah.
Private money from, people who I've met in rooms like this.
So the biggest thing you would say as far as raising capital, number one, taking the action to do it, booking appointments, but what is
thinking long
that?
term with relationships. Like,
Okay.
it's not just go have lunch, right?
Mm-hmm.
And I didn't mean to cut you off, but like, it's the idea. It's like so many people like, oh, go have lunch with someone, and someone's going to be there, and they're like, lunch, and maybe they'll think forward and like go pick up the bill and pay the bill. It's not that. It is get to know them, build a relationship, because at the end of the day, too many people want to take a deposit, like take a withdrawal from a relationship before they deposit into it. So I'm looking to build. When I say an ally, I'm like, that's more than just a transactional relationship.
And for the successful wholesaler, the successful builder and flipper that has those cash reserves, that feel like, I don't need extra money, I got a machine running, I got enough money, what's your advice to them, and why is private money still important?
My current theory, so when I bought my first creative finance deals, it taught me a very valuable lesson, because I was focused on only using my money. Even though it was only a little bit out of pocket, very quickly the bank of Courtney got tapped into because I didn't have proper reserves for repairs and vacancies. And I eventually had to sell those properties. And now my current theory is this, that when I buy properties, so that is considered to me offense, right? So when I go and buy, like offensively buy properties, I'm using other people's money. But in order to maintain those properties, to keep them long term, that is the money in the bank that I use. Repairs, the reserves for vacancies, because at the end of the day, there's plenty of people who've aggressively bought properties, but how many of them still own them? Go through enough. I have not been through a changing market. 9-10 years in this business, that's not enough to have been through a down market. My mentors, who I respectfully call the gray-haired guys who've been in this for 50 plus years, they have told me countless stories of people who grew so quickly, but they're not here today. They don't have properties today, right?
What's the reason why?
They grew too fast, too quickly. They bit off more than they can chew, but they don't have the reserves. Buffett said it is, when the tide goes out, you'll see who's not wearing underwear. And so at the end of the day, it's like this idea of, again, whenever I'm going out and buying properties, I'm utilizing other people's capital literally as a strategy so that I can take the capital that the businesses are making, and my capital is keeping the home front safe, right?
Yeah.
Too many people, they think too short-sighted, and they don't plan for that, the underside, the down, different things like that. So yeah, you can use your own cash.
But for how long?
But for how long?
Yeah. I'm glad you said that. So, and we're going to get into the creative stuff. Tell us about underwriting those deals to make sure when you're using other people's money, whatever the exit is, what's the extra layer of underwriting to make sure everybody gets cashed out?
That's so important, because I think so many people love the idea of using private money. But you don't understand, that's people's life savings, right? That is people's, their spouse passed away and that's, what they were left with or whatever, right? So at the end of the day, you need to respect it because they're trusting you with that. Now, don't get me wrong. They're grown men and women who need to the buck doesn't just stop with us. It also, there's some responsibility on their end. But actually, when I had that line of credit, some of my worst deals were with that line of credit. Yes, arguably you could say I was, early on, but it was money burning my pocket, right? But then maybe if you're anything like me, utilizing other people's capital, I'm like, I treat other people better than myself, and it's probably something I can talk to my therapist about. But the reality is I really need to triple check all my, dotting my I's and crossing my T's. I mean, hey, let me go look at that ARV and not just glance over it, but hey, is this something that I would feel very confident that I can perform on, right? Because some of you have heard me say this, but a lot of people think we're in the house business, which that's good and fine because in all reality, that's true. But I disappoint many people because I care less about the houses. So maybe then you go on and you've heard people say we're really in the people business. Yep. Would you agree?
Yep.
I think even more than that, we're in the business of making promises and keeping them. And so the strength of my business is in the strength of me, making these promises and keeping them. Because the minute that we stop, right? The minute that someone stops making keeping their promise, for example, to the bank, what happens? Foreclosure, right? You don't pay your contractors. What happens?
Liens, mechanic liens.
Yeah, all those things, right? What happens if you, you tell someone you're going to buy a property from them and then you don't because you skirt around them because you don't care about your word. I mean, that word spread super fast in this community. I swear. There was one day a deal went bad in North Mississippi, and I got a phone call by noon. I was like, dang, I didn't even think you can get down the, I-59 that fast. But so word spreads, right? So a big part of that is with private money, you need to be a person who can handle the responsibility of other people's money. But here's the thing is handshake deals, and look, both of my parents are from Mississippi. It runs in my blood. Don't do handshake deals with other people's money. It needs to be done in front of an attorney with a mortgage, with a note, properly documented. Things for example, the insurance, they need to be added as additionally insured, just like you would with, Chase or Vertical Capital, you need to go those extra miles because at the end of the day, if I get hit by a bus, I want all the promises I made for the people on the other side of those promises to be protected. And just because I had the intention of protecting them doesn't mean anything at that moment if I didn't set things up right.
Gotcha. So let's move forward. How does private money kind of get into the mix of the creative stuff? So first of all, how do you define what you're doing it on a daily basis? How do you define creative finances versus what do we
a lot of people call it a lot of different things. Yeah.
Mm-hmm. But how do you define it?
So for me, it's just using non-traditional ways of being able to acquire properties. For me, the majority of the time I'm using either the seller that's in place or their existing financing that's in place. Technically some people say private money is creative financing. Yeah. But,
And traditional, you mean getting a property under contract, going to a bank, getting a loan, buying it, or buying it with cash, right?
Yeah,
Gotcha.
correct.
So we got a couple of different scenarios that we want to get into, and hopefully this is some things that you can add into your toolbox with either a deal you got under contract right now or the next property you're about to buy. So let's dig into this first one. Tell us about, we're going to define the strategy, and then we're going to get into the numbers. So what type of deal was this?
All right, so this is a deal. It's a seller finance deal. And
also called what? So what's some other?
So some other term. Thank you. Yeah. Because there's nothing new under the sun. Mm-hmm. Just because it's some flashy thing on YouTube doesn't mean the guy made up the strategy. Seller finance, seller carryback, owner financing, or a purchase money note is another one.
I want to add to that for the realtors, because these designations are in the MLS: buying for deed, lease purchase.
So actually, no.
All right.
So that's a different strategy. But okay. Hey, that's not seller financing.
Okay.
But I love that, and I have that as one of the case studies as
All
a
right,
bond
so
for deed.
let's dig in.
So
let's dig into
technically,
yours.
those are so a bond for deed is an installment sale, and sometimes seller financing is considered an installment sale as well.
So what's the difference? So if I got an installment sale versus owner finance, how we look at it? And we got David to help pick it back if we.
No,
if
hey,
we-
look, this
if
is
we straddle
actually
illegally.
huge. If you guys write down publication 537, the IRS has this publication. It's number 537. Fun fact: you can go on the IRS's website and look up publication 537, and you can print it out. So it is on installment sales. I have had some really technical sellers before where I've printed that up, stapled it, and given it to them at a closing, had my copy with highlights saying like, hey, let's look on this page at this, to talk about the tax benefits of it, right? But an installment sale, the main difference between seller financing and a bond for deed is title transfers with the seller finance. A bond for deed, the title stays with the seller until I perform, until whatever the performance barrier that they set was. Okay. So it may be, either a certain amount of payments, all the payments, something along those lines. Seller financing, the title transfers to me up front, and then basically the seller is given a first position mortgage and note on the property, and I make payments to them like I would any other lender.
Got it. Remind me to ask David this question. With the care of, unless you have the answer to it. So I know the title transfers will own the finance. Those bond for deeds, sometimes I see on the tax bill that it might say, let's say, Deep Root Investments, or it might say the seller name, and then it might say in care of Deep Roots Investment. How does that look?
It could very possibly look like
does
that.
that still count as title? No? David? Care, okay, so care of is not title transfer. Okay, that's good.
It doesn't necessarily mean that. Yes. Yep.
Okay.
Mm-hmm. Yep. Right. Mm-hmm. That's actually very true. And look,
Perfect.
the bond for deed could have the seller paying the taxes, or it could have the buyer paying that. So,
Yeah.
yeah.
All right, cool. So now we know the definitive definition of owner financing. I actually get the title, but let's move forward. So tell us about this deal.
So yeah, one of the biggest things is I don't want you to get caught up in all the different strategies per se, because they're just different tools in the tool belt, and I use them, but I use them for different reasons with different sellers because I solve different problems for different people, right? Not everyone. Let me say this. Here's a principle, a creative finance principle that I don't think is talked about enough, is the best creative deal is a custom creative deal. Without a reasonable doubt, I'll share about this here. So this is a property actually in New Orleans East. I was actually out there earlier this morning. Fun fact, I bought this property on September 20th, 2022. So I actually was meeting up with the seller earlier today, and so, yeah, I was right in the area in New Orleans East, also chef. Don't worry, I didn't stay long. So this is on Dot Avenue in New Orleans.
Okay.
So you want me to talk? You go with me to get rolling in, or you want to ask questions?
Yeah. So what type of deal is it? How did you find it, and what type of deal is it?
Yeah. So actually, the seller contacted me off of the radio show. For those of you who don't know, I have the pleasure of being on WWL each weekend, so 8:70 a.m. and from 11 to 1 on Saturdays for the Home Improvement Show. My co-host Paul LaGrange answers all the building science related questions, and I answer all the real estate. So for 2 hours, I don't know what's coming at me. It's fun. We actually have some listeners in the audience today that are here.
Thank you.
And she contacted me, shot me an email and said, hey, I have this duplex I inherited. I want to no longer be a landlord. What should I do? And so we jumped on a call. One side was vacant. And I said, honestly, look, at the same time, I like to give advice as if it was a family member. I said, one side's vacant, go put it on the MLS. Like someone who can live, like the person who will pay the most, because that was what she valued, was who would pay the most. I said the person who's going to pay the most is someone who's going to live in it. So having a vacant unit is a perfect setup. So she put it on the MLS and then contacted me 70-something days later because it was still on the MLS and 2 buyers had walked away at this point. And so she was not, so this is September of last year, not, really hopeful of what the future of the market was going to be. So she's like, hey, I just want this to be done. I'm continuously having to pit, thank you, Dad, for these properties, but I'm having to continuously put money into these properties, right?
Yeah.
And so she wanted to be able to move on, but 70 plus days on the market, 2 buyers walked away and still hadn't reduced the price. So when I looked it up, I said, hey, is there any reason why you haven't, reduced the price? Because, that'll get you some action, right? And she's like, no, that's what I want. Okay.
Top dollar.
Yeah, that's what I want.
All right.
And the buyers had walked away because there was a cracked joist underneath. That cracked joist had scared the bejesus out of. How many of you guys would say, hey, that would scare me away from buying? Yeah?
Yeah.
Hey, Stephen Leonard, how much did we anticipate that being? What's the repair cost of that? What did we estimate? 2,500? Less scary? Most people, a foundation issue will scare buyers away in a heartbeat. She couldn't even make concessions for those. They were just like, nope, nope. And you see, it wasn't a major repair. It sounded bad, right? So I configured the ARV to be about the after repair value. So fixed up, this property be worth around 175. So at 155, it still wasn't bad, but it was the East. September of 2022, the market's starting to adjust. Interest rates are going up, all these things. So I go and meet out there and I say, look, I'm giving her all these reasons why I'm not her buyer, right? But I said, look, at the end of the day, I can give you the price you want if you're willing to work with me. Are you open to that? You open to hear? She's like, I'm open to hear all the options at this point. I said, okay. And so ultimately, if any of you guys have heard about creative financing before, a very common analogy is the seesaw, that if they want their price, then on the other side of the seesaw is the terms, how they're going to get it. Any of you guys heard of that before? Pretty common, it gets around. But the way I like to explain it is, at the end of the day, if we're playing at recess and we're standing out there, so if you and I go to the playground right now, stand in front of a seesaw, and I say, hey, this one is 155, and this side is how you're going to get that 155. Well, if you tell me that, and I go sit at the 155, so then you're obviously going to sit at the other side.
Yeah.
But if I get up and go scoot you off and go sit there too and say, well, no, but this is how I'm going to get it, then I'm like, okay, obviously this person doesn't play well with others, right? That's what recess taught us. So the reality here is she was willing to figure it out together.
Yeah.
And for creative deals, I'm not trying to be, the better negotiator on the other side of the table. I want to be on the same side of the table as them, and I want to be a part of their solution. She had a problem. She wanted to get a certain number, but she wanted to get out from that. And I said, hey, I have some solutions. Are you willing to figure it out with me? I have some ideas.
Yeah. Which one you pulled the trigger on? What was the type?
So I eventually bought it for, here's the numbers, $82,000. My out-of-pocket at closing was $7,604.40. So that went toward closing cost and commissions. So obviously it was listed, so we eventually worked with that. 5% interest, $440 a month, 19 cents for 360 payments. Anyone know what 360 payments equal? Anyone want to guess how old this seller is? She's not 21. She's in her 60s. A common belief is that people won't accept long-term seller financing in older age. And there's no balloon on this, so it's the full 30-year. So if you learn how to use a financial calculator, if you can pull it up online, the principal ended up being just under $82,000, but the interest was $76,471.93. So her total over those 30 years was $158,468.40. She got what she wanted, right? And she didn't have to do any more repairs. When I met her, she only had one side rented out at $700 a month. That was Section 8. And so with, insurance and taxes, that $440 is easily what she was, netting every month at that point. She didn't have the other side rented out, and she didn't want to go through the hassle. So I was pretty much matching what she was getting at that point. And so yeah, now it's rented. One side is rented at $1,000. The other side is getting rented out at $1,000.
All right, so let me backtrack with you real quick. So she wanted what? 'Cause I know originally she was
155.
Originally she said 175, but ended up wanting that.
No, ARV was 175.
Oh, I'm sorry. Gotcha. So her asking price was 155. So normally somebody would try to take that 155 and spread those payments out.
Like 0% interest over time.
Something like that. But you made a whole at the 155 by the principal being what?
82,000.
And then the interest over time equal to
76,000 and some change.
which gave her purchase price of.
It gave her 158 over time.
I'm gonna clap for that. That was
So-
good.
Thank you. Let me say this. She would have given me 155,000 at 0% interest for 30 years, without a doubt. I was not a buyer at that price.
Yeah. Why? What's wrong
Anyone
with
else think like, you're crazy? So this is a rental for me, right? First of all, we're already having issues with insurance. The insurance was like very high on that property, double or triple what it should have been because of what we're going through right now. So I care about cash flow, right? So a huge part of that deal was I went and got doing my due diligence, I went and got on the tax assessor's website, and it was assessed at $76,000 or $78,000. And so if I would have bought it at 155, what would have happened to my taxes? They would have doubled. This is the power of learning how to underwrite, because most people don't look into stuff like that.
That's
and
good.
then all of a sudden down the line, because look, we're getting hit with the, insurance right now, but what's coming down the line is property taxes are going up next. And most people, rental properties are a game of inches. And so I'm very minding my inches with these. But the other thing was I offered to pay commissions. If I would have done 155,000 at 0%, I'm paying real estate commissions on the principal. So I did also have less money out of pocket by lowering that principal. And she saved on capital gains.
She is who?
The seller.
Okay.
Because she inherited them in 2014. And so she has a basis in them. Here's the thing. Some of you don't care about taxes, and I'm talking Uncle Sam taxes, not property taxes. Here's the thing is, if anything, go learn them to help someone else. You'll either help someone who has a high income and they can become a private money lender, or you can help someone who is a seller. I have helped a ton of sellers with their tax situation, and that is how I've gotten a lot of these creative deals.
And what's the tax benefits for you as an investor? Because you could have did this inverted. You could have front loaded on the interest and lowered the principal, but you still went up on the principal. So
I didn't really think about it from the tax perspective. I was thinking cash flow.
Okay, but what did Bob say that so happens to be the benefits the way you did do it?
I mean, I can write off interest payments.
That's good.
Versus
Okay.
0%, you can't write that off.
And does purchase price impact insurance? So when you get that dwelling policy and flood, if you would have told them it's 155,
I don't think so. Is there any insurance agents in here?
Yeah, any insurance?
Replacement, yeah, because we're not going out of cash value, we're going out replacement values.
So replacement is at 80 versus.
No, replacement's the actual cost of replacing it. So
Okay.
whatever, I don't know, 190,000, whatever it cost. I don't know. It's a
Yeah.
duplex.
Nah, that was
so
good.
190 sounds about right to build it brand new.
Cool. And title is in whose name?
Title is in my name,
Okay, that's perfect.
our entity's name.
Yeah, perfect. Nah, I like it. Let's so that's owner finance, title transferred. That's good. Tell us about the next deal.
Well, let me just say this. Something that's really important. Do you mind if I say one more thing about
Go ahead.
seller
Yeah,
finance? I'm a big believer in how you do real estate matters, both from how you treat the seller, but also how you do it technically. Because most people don't do the paperwork right, and therefore they, shoot themselves in the foot. Like the not looking at the taxes thing and then projecting that the taxes would go up. So with the seller financing, actually the real estate agent recommended we do a bond for deed on that one. And so I said, okay, let's talk through the difference between the two. And then what it came down to was that agent had never done a deal like this and had only ever gone to a CE class on bond for deeds. So was just using the tool that they had learned, right? And I don't blame them for that. And so then I asked, hey, no shame here, but is anyone helping you? And eventually we found out that their broker was helping them, but their broker had not done a lot of deals like this. So keep that in mind. People use the tools they know that are in their tool belt. And I said, well, look, this seller had routinely told me she wanted to be done with tenants, okay? Here's the reality, and she wanted to just get payments. She didn't want to be involved down the line. She just wanted to get the monthly, automatic payments. A bond for deed, I have two tenants that are, Section 8. It's New Orleans East, right? If anything happened and I got sued, they would actually, with a bond for deed, would include her on the lawsuit because she's on title. For seller finance, she's in a lending position with a mortgage and a note. Generally speaking, they don't include a lender in your lawsuit when you get sued. And so I explained that in a few nuances, and she said, no, we're sticking with what we had agreed.
Yeah, perfect.
So.
And for the people that haven't done one before, what does the paperwork look like to do this correctly beyond the purchase agreement?
Yep.
What else is in your toolbox for as paperwork to seal this deal
Yeah,
and send it
so
over the title?
There's a lot, and it's more than we have time to jump into, but the mortgage and the note that are tied against the property. So it's a mortgage that ties that note, which is that promise. It ties it to the property. If you're new, listen to me. But at the end of the day, I believe in the people on my team are very big. Like, I believe in they're the who know the how, right, on my team. But when it comes to the paperwork, I work with them. I don't just say, hey, give me what you got. I actually like to build my paperwork by design, not by default. But I want to also make sure it's legal, right? So there's some things. So technically, this seller called me, and she was at a snowball stand, and she had like 25 questions that we went through when I made her the offer. And I said, I'm glad you're asking these things. But one of them was like, what happens if I die? When I die, right? Where do that $440.19 go?
Good question.
Anyone have that question? When I said a 6-year-old for 30 years? I said, well, that is an excellent question, and if you wouldn't have asked it, I would have. I said, tell me this. Do you have, any heirs, any kids? Yeah, I do. Next question, do you have a will? No, I don't. Do you want to know what I also included in this deal? I paid for her to get a will done. Did I need to? No. But how you do real estate matters. Would that not benefit all parties involved? I'm a huge believer that at any transaction, one of the biggest things you get out of it is an ally, not the house. Don't get me wrong, the house is great, but more than that, it's the ally. So I was setting my future self up for that. I called the attorney. They have a civil department. I said, I don't need to know any of the details. Just add it to my side of the bill. Call her. They called her, set up an appointment, and they set up a will for her, a basic one, not some complex estate planning, because that was important to me, right? So then here's the other thing is in the seller financing, I had multiple clauses, but one of them is she now has a note, right? Anyone in here buy notes? I know Justin Harris does. Anyone else here buys notes? I see a few hands. There's a whole industry that buys notes. Anyone had their mortgage sold before? So they're paying Chase, now they're paying Wells, now they're paying. So the minute she now gets this seller financing note in public record, she's going to start getting letters in the mail, just like the We Buy Houses letter. She's going to get the We Buy notes. And she's going to be solicited because they want to buy that note. And how they make their money, note buyers make their money by buying notes at a discount. So without boring you with all those details, I just said that I just want the first right of refusal if you ever plan to sell this note at a discount. Because if in the future you decide, like, I don't mind, paying a different person. But at the same time, if they got the deal, if they got this at a deal, well, if you have so what we agreed on is if she gets a bona fide offer to buy that note, like a legitimate one, and she wants to collect all that money at once down the line, I just want first right of refusal to pay that. I will make her whole in that regard, but it gives me an opportunity, one, to have, instead of having to pay a stranger, because I'm agreeing to pay an individual that I know, so now I'd be paying some stranger from whoever knows where. So in essence, I'm getting to choose my lender. Does that make sense? But then the second part of it gives me a second bite out of the apple, right? I structured the deal up front, but then by building in some of that, it gives me a chance to structure a second part of the deal down the line. So that's just one of the few clauses I build into my paperwork.
And that was in the purchase agreement?
No, so it was in there, but it was also very specifically, it's in the note, in the mortgage.
Perfect. So we got note, we got mortgage, we got purchase agreement. This was a custom product to add the will.
Let me add one last thing in here is I promised her she got her money over time, right? One of the objections the agent had was that, well, you're giving it to her for $82,000. She can just go tomorrow and refinance it or sell it and cut you out of the the $155,000, right? Anyone else thought about that? So we had a list of objections from the agent. And so when we went over, I go, okay, well, how do you feel about that? Because she's like, no, we've talked about that. I'm good. Because she already knew, we'd already talked about that. I built into there a prepayment penalty equal to the remaining balance of interest. Because our agreement was she was going to get that. I wasn't interested in cutting her out of her share. No. Again, I believe I'm in the business of making and keeping promises. So a promise I made was she would make that full amount over time.
Good. Next deal.
All right.
What you got?
Bond for deed. So in other states, it's a contract for deed or land contract. This is one in Covington that Steve in the back, he got this lead and said, hey, Courtney, this is in a neighborhood that we had just done a deal in. And he said, hey, that neighborhood, it's not an easy neighborhood. It's down by the courthouses in Covington in the West 30s. One of these houses had a bullet hole in the side of it still.
In Covington?
Yes. Down, we do still have those areas. Okay. There's only like 2 of them. And look, so he's like, hey, come join me on this walkthrough, see what we can figure out. And before the deal, before it, they were wanting like $215 if you paid all cash, $200 for 3 houses. 2 of them are right next door. 1 was across the street. What ended up happening was we go on the appointment, and they were supposed to be turnkey. A seller was very proud of all of the self-management and repairs. And so I'm like, all right, turnkey. 2 of the tenants wouldn't let us in. Long story short, we found out why. They were not turnkey. There is a photo that exists on the internet of my body halfway through the living room floor because there's a hole in the living room floor.
And they were living there like that?
Because it was leaks that were not reported for a very long time. And so the 200 for the 3 became very negotiable. This is what I watched the guy's face go white because he was just he was so proud of all that he had done, and he just felt so taken advantage of in the situation. He wanted to retire. I love retiring landlords. And so I said, look, man, let's talk. He said something in the walkthrough that I was hitting Steve right behind him, did you hear that? So when we pulled around the corner, I said, man, at that point we had wholesaled a few deals together. I said, man, I like you enough at this point that I respect you. I would own a deal with you, or heck, I'll buy it at this point. This guy will finance this deal. I heard what I needed to hear.
Because he said that during the walkthrough.
One of them, he said, I can't believe she's treating us this way. We even financed the property to her, but because she couldn't make the payments, we had to take it back.
He already on the finance.
He had already done it. And I'm like, but what I heard was that he had just done it to someone who didn't have money. And I'm like one's not like the other. Right. So one of the things there is, so I just said, hey, look, man, he even more wanted to retire and get out the business at that point. So here's how we bought them. So again, 3 single families, 2 next door, 1 across the street. Total purchase price was $150,000. with $10,000 down, and the $140,000 balance was a 1-year balloon. So in 1 year, that remaining $140 was due. So each month we were paying them $1,200 a month interest-only payments. Don't ask me where that number came from. The only thing I can understand is that I think they had a home equity line of credit that was equal to that, about their monthly payment was that. So at that point, the rents were $2,800 a month on the 3 houses. So when we included us paying for taxes and insurance, we were coming at $1,700. So the $1,200 plus $500 for taxes and insurance. So we had cash flow, right?
And that's as is. That's what I.
As is.
Okay.
All 3 of them had tenants in them. But what we learned, 2 of them weren't good tenant situations, right? So eventually, look, I've done a lot of rehabs over the years. I am becoming more and more allergic to doing the deals, but I'm becoming doing rehabs, right? To the point though, but I'm more and more confident in my ability to structure deals that I still routinely buy messed up houses. I just structure deals well to offset that responsibility being mine. So what ended up happening is, so we bought them at the 150, the 10 down, and what I ended up doing, we evicted one tenant who, like, at the walkthrough was like getting in people's faces, so like she was gonna go. The other one we worked with, and we raised the one with the hole in the living room. Even the seller at closing went and put plywood throughout the whole house just to make it safe. So it was obviously need to get fixed, but it was safe. So we worked with her on getting her rent stabilized and at a decent amount. She had not been raised in 10 years. But then the other one across the street, which was the best house and the best tenant, we stabilized that rent and raised it as well. And then on March 14th of 2022, so I bought those October 31st, 2021. Then middle of March of 2022, I sold the 2 worst houses for $152,000 and walked away. The cash to seller was $4,500. So that left us with what? A free house. Mm-hmm. That last house, which was the best house with the best tenant, was it's a 2-1, brings in $775 a month in rent, and it's worth fixed up $115 to $120. If we would have wholesaled it, we probably would have made $30 on it. That was a bond for deed, so the title stayed in the sellers. And I normally don't do balloons, especially not a 1-year balloon. I normally don't really like interest-only payments, stuff like that. And I also don't like putting down $10,000 when it needs a lot of work, right? But I was able to not say, hey, here's my, I was able to see through the situation and say, yeah, I usually don't do XYZ, but if I look 30,000 feet, there's a deal here. And I'm like, and so, we shook their hand and we did the deal. Now down the line, one of the things I built into the paperwork is we didn't know what we were going to do with the houses, fix them up, keep them as rentals, flip them, whatever. We just knew we had options. I built into the paperwork that each house had a value on the bond for deed as well as in the payment, so I could peel off a house if I wanted to. So when I peeled off the 2 houses, I could have just kept making those payments, but the price we sold it at paid off the rest of our debt.
That was by design or happenstance? That just happened?
My friend, it's all by design.
Okay.
It's all by design.
That's good.
And no attorney is going to build that into by default. Like, that's not going to happen. And so much of this does not happen by default. And so what does it do? It takes being a practitioner and a deal maker to know how to build some of this stuff in, because I wanted that option, right?
Yeah.
How many of you guys have ever had a mortgage where multiple properties were included and you couldn't do something with one of them? Frequently, right? Yeah. And it can stall the ability of what you can do with the deal.
Yeah. And which all of these custom built exits that you're putting in, these are individual pieces of paperwork, or they're all baked into
so that was one bond for deed.
Purchase agreement.
So that was a bond for deed. And so that wasn't, the individual prices wasn't on the purchase agreement, But when we were doing the bond for deed paperwork with the attorney, I have them send it to me. I add my edits and I send it back. They make sure it's legal because I obviously want to stay compliant, legal, all that stuff.
Right.
And then we sent it to the seller to review. And I called them and I just said, hey, look, we're going to give you, within the year, we're going to make you whole. In the meantime, if we fix some of them off and sell some, how do you, or do something like that? Are you okay? She said, yeah, as long as I get what we're agreeing on.
Yeah. One last thing on this particular deal, you talked about tools when you talked about the realtors use, the tools that they exposed to. What tools are kind of guiding you through these to make sure that they're being pressure tested on paper, and then once you close, they actually live out like this in reality?
I just make a lot of notes of like the underwriting. I'm getting better, trying to make some checklists for underwriting, making sure I'm looking at all the things. But man,
Just pencil and paper?
at the end of the day, here's the thing: is each deal teaches me something new. But what it is when I do creative deals, I will talk with one of the best things. If you want to get in creative financing, go get around other creative investors, because one of the things I do is earlier today, I had a phone call with a friend from Atlanta, my friend Ari, and we talked through 2 deals together. This is one of my friends. We're talking through these deals, and I'm like, man, what about this or this? He's like, I haven't thought of that yet, right? A big part of creativity is a lot of times you need good muses, right? Like a good bit of inspiration. Don't get me wrong, I've got a ton that I can pull from in my head, but sometimes the best thing I can do is just go talk to someone else about the deal. Half the time, that's why I routinely come to these meetups. I love talking with people because it gets the juices flowing of like just thinking about options. Because there's always another problem to solve, whether it's a seller's or our own or someone else, right?
Yep, that's good.
So
man.
that's a huge tool.
Yeah, strengthen community with people just like this in this room. So let's get to the last deal before we get to questions from the crowd. Okay, let's go.
Let's do this subject too. Anyone want to hear about this one?
Right.
I'm closing on this tomorrow in Kenner. ARV is 200, 225-ish. Guy inherited mom's house. Didn't know mom had a loan. Didn't pay mom's loan. Mom's now in foreclosure. So this is one that I'm buying. The first mortgage, I'm buying it subject to that existing mortgage. So the deed's going to transfer to my name, but that loan is going to stay in actually the deceased seller's name, the estate's name. That loan is just over $91,000, okay? This is a 3-2 brick on a slab in Kenner. That, again, we're fixed up is 200, 225. Do you guys feel like there's some opportunity there with that first mortgage? This seller had already had multiple people walk away because right across the street from it is a bar. And so it's like part residential, part commercial, and it needs work. So I am getting a private money loan for $64,000. I have a financial friend. I have a relationship I built. Guy had a IRA, a retirement account that he wants to put to use. He's lending $64,000. And so the 91, the 64, that's 155. So it puts it at around, I think, 74% loan to value, okay? That 64 is going to catch up $29,000 that it's behind on the loan. We're paying $9,400 in liens that I had to go negotiate. Closing costs, we're paying Arion some lead management. We're paying various, and then $2,000 to the seller. He was to the point where he was just going to walk away from this deal. But I said, look, you have something I see as valuable here. So ultimately, what I'm giving him $2,000 just for the hassle, because it's not his credit, it's his mom's, right? And she's deceased. Now he is getting some of those liens were tied to him, so he is getting some relief of that.
That's good.
So ultimately, we're buying it all in. We'll be at 155. So that includes that 64. Also includes the repair cost. So we're gonna fix it up and sell it on a lease option to someone.
Yeah.
Actually, we're gonna sell it for $225 with $25,000 down, and so pretty much we're gonna get 3 paydays on that when we sell it on that lease option. So we're gonna buy it creatively and sell it creatively for someone to live in that house, and they're gonna put $25,000 up front. The way I have it structured is at $1,750 a month rent payments. So between the first mortgage and the second mortgage, my monthly payments are going to be, basically the cash flow is going to be $357.30. So if we get even, let's just say if we give them 2 years to buy us out, let's just say they give us 20 months of those payments. I mean, that's over $6,000 of cash flow. And then if we sell for the 225, they put 25 down. So when they refinance the 200, we'll get the difference between the 200 and the 155. So that's 45,000 we'll make then.
Right.
So in this deal, we'll make over 70 grand on this deal. But multiple people walked away from it because the only tool they had in their belt was cash, or the only tool they had in their belt was flipping or rentals. This didn't work as a rental, not with the bar across the street. I didn't want that as a rental, right? But someone's going to want that as a house if there's financing involved, right? So this is a deal that this is actually one of my favorite ways to do subject to deals. I'll buy it subject to the existing mortgage. I'll take over making those payments, and then I'll put it on a lease option on the back end, so that we can get this moving along.
Yeah, that's good stuff. So we didn't already walk through our owner finance deal, a bond for deed deal, and a subject to deal, real life case study. So all those are good. Steve, you want to come up, get ready for needs and wants. We're going to take questions from the audience. Anything else you want to add about that subject to deal? Any special paperwork?
Let me say
that subject to deal, kind of like the other deals.
Well, subject to, I have an entire packet that is your 1,000%. You want that most of, let me just say this, 1,000%, the subject to packet I include on these deals is so important. I had to do insurance claims during IDA on subject to deals, all these sorts of things, and probably got more than 24 phone calls from people from, everything from real estate brokers to other investors who've been doing this for a while, who did not have the proper paperwork and could not be made whole from insurance claims with these types of deals. So that's really important. Here's the thing. When I underwrote the deal, the PITI on the last statement was $761. The new PITI that I will be paying starting, in a few months will be $1,000.16. Most people do not understand with the subject to deal that 90% of the time the PITI does not stay the same. And so because they don't underwrite that, it was $254 is the difference between what I saw on their mortgage statement and what I'm going to be paying. That is some people's more than their cash flow, right? And so please, 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 when learning these creative deals, get around people who are competent and experienced to learn, because there's so many people setting them up that don't kind of dot their I's and cross their T's, and then next thing they know, they're hurting. And because it's tied to a promise, it's hurting someone else as well.
And those notes jump up because of the escrow, property taxes, and insurance?
Bingo.
Okay, gotcha. We're going to take questions from the audience right now, and then we're going to do needs and wants. Question is, you repeat the question because I don't remember.
That's a fair.
You remember?
Basically, if the loan's still in the mom's name, how can I, if I'm going to take over making the payments, how can I take possession? Okay. So basic. Correct. So when I buy a property subject to the existing mortgage, really what that is just a disclosure that the title has something still tied to it, which is a mortgage. Now there is a clause within that mortgage that says that the bank has the right to demand all of that payment at the time that title transfers. It technically often says they have the right, not the obligation. And so there's always the threat of that risk of that being called, which is why I can tell you right now, it's not one of the safest ways to do it, because they could call it due. I've seen less than 1% of these deals where that gets called due because, well, as you see, $29,000 is being caught up and the payments are being brought due. Often when they're getting paid, they're happy, but they have the right, not the obligation, but the right. But no, it's all done in front of an attorney. There's one in the back of the room who does them. No, because the bank's not at the closing. What is done with all the paperwork is addressing that there's still a loan that's tied to the seller that's still on the property. So it's a disclosure within the deed. It's a disclosure within all the paperwork that is signed. Yep.
We had a question up front.
Well, so here's the thing is, I like to call it the mad scientist behind the curtain. Are anyone's head hurting? Just a little bit? It can all, like when I get around this stuff, sometimes my head hurts, right? Especially when I got introduced to it. All of those different levers, the monthly payment, the money down, the principal, the interest, the timeline, the term, all of those are different levers. I like to keep that the mad scientist behind the curtain. But yes, I play with those all day long to get the deal to make sense. But here's what the deal that happens. A seller, you can all day long play with those levers, but most people can't get sellers to get them to accept them. The best deal, the best creative deal is a custom deal that suits people's needs and solves their problems. But it has to be a win-win for everyone. So at 155 at 0%, I didn't want that deal, right? So you need two willing parties. I said, look, it's a rental for me. I'm not thinking sales, right? Because ultimately I'm going to owe that 158. If I sell it tomorrow, I still have to give her all that interest due. So I'm not really thinking selling. I'm thinking cash flow.
Last question. Good question.
So is there a specific attorney that I work with, and are they familiar with this? Most of this I've brought to them. So it is a collaborative effort. There is a guy, John Stevens, with Arena Collective that I've done a good bit with. I have worked with other attorneys, and I am still working with other attorneys, but he is one who I've done some deals with. I use a tool called the number 10, the letter B, and then 2 I's, a 10B 2I calculator. It's a financial calculator.
And the question was, what made you come up with the 5% on that?
Correct. What made me come up with the seller financing 5%?
And it's a 10 what?
10B 2II calculator. It's a financial calculator. I use that daily for when I'm structuring private money or when I'm structuring creative deals. I basically got on there and I played around with various different levers, right? The interest, the terms, meaning how long of the payments. And then basically when I played around with all of that, I looked at what my payment would be, and I played with those different levers because I still cared about, cash flow. So that's how I came up with it. Ultimately, we first agreed on 4%, but then the realtor said, well, bankrate.com said the average rate today is 5%. I said, fine, give it to her. There's a difference between $20 a month, not even.
So that's how we
Good question.
Yep, good stuff. Well, everybody give Courtney a round of applause. Thank you for coming out.
Thank you. Thank you so much for having me.
Nah, thank you.